So you've finally hired someone. Maybe it's a part-time VA, an editor, a subcontractor you put on payroll because they were basically full-time anyway. And your accountant just told you your solo 401k doesn't work anymore. That's the trap nobody warns you about. And the longer you sit on it, the more it costs you. For every year you delay setting up the right plan on a $90,000 net profit, you're leaving roughly $3,000 to $4,000 of federal tax savings on the table, based on the 22% bracket and the 2026 contribution limits the IRS just published in Notice 2567. Multiply that across 3 or 4 years of "I'll figure it out later," and you've handed the IRS a used car. There's a plan built for exactly this moment, the awkward one-employee stage, and almost nobody talks about it. Here's the thing that trips people up. A solo 401k has solo right there in the name for a reason. The IRS designed it for a business with no common law employees other than the owner and a spouse. The second you put a non-spouse W-2 employee on the books who works more than 1,000 hours in a year, or under SECURE 2.0, more than 500 hours for 3 consecutive years, your solo 401k is no longer solo. It becomes a regular 401k, which means testing, filing a Form 5500 once assets cross $250,000, and covering that employee. Most freelancers I talk to don't realize this until their tax preparer catches it, and by then they've been contributing under a plan they weren't technically eligible for. Not great. That's where the SIMPLE IRA comes in. SIMPLE stands for Savings Incentive Match Plan for Employees, and it lives in Section 408P of the tax code. It's designed for businesses with 100 or fewer employees. No annual Form 5500. No discrimination testing. No third-party administrator. You open it at Fidelity or Schwab, you hand your employee a 2-page notice, and you're basically done. That's the appeal. The paperwork is genuinely low for a plan that covers a W-2 employee. Now let's talk actual numbers, because this is where it gets interesting. For 2026, the SIMPLE IRA employee deferral limit is $17,600 for standard plans with a catch-up of $3,850 if you're 50 or older. And there's a new SECURE 2.0 super catch-up of $5,250 for ages 60 through 63. Some employers can also elect the higher SIMPLE limit, $19,500 in deferrals, if they meet the SECURE 2.0 rules for smaller plans. I'm citing the IRS's 2026 inflation adjustments here, published in Notice 2567. Alongside the broader retirement figures, the 401k elective deferral limit went to $24,500, the IRA limit to $7,500, and the total defined contribution ceiling to $72,000. Your actual room to contribute depends on your net self-employment earnings and your bracket, so those caps are ceilings, not targets. Here's the part where the SIMPLE IRA stops being simple in the everyday sense. You, as the employer, have to contribute for your employee. 2 options. Option 1, a dollar-for-dollar match up to 3% of the employee's compensation. Matching only kicks in if they defer. Option 2, a flat 2% non-elective contribution to every eligible employee, whether they defer or not. That's the trade. You get an easy plan, but you're on the hook for a small employer contribution. On a $40,000 W-2 employee who defers 3%, your match is $1,200. That's the cost of admission. Now let me actually walk a real example, because abstract limits don't help anyone. Say you're a 38-year-old freelance designer. Your Schedule C net profit for 2026 is $90,000. You just put one part-time editor on payroll at $40,000 salary. Under a solo 401k, you'd be out. You've got an employee, plans disqualified. Under a SEP IRA, you'd have to contribute the same percentage of pay for your employee as you do for yourself, which gets expensive fast. If you want to sock away 20% of your own comp, you owe your editor 20% of theirs too, which is $8,000 out of pocket. Under a SIMPLE IRA, you defer $17,600 of your own owner comp as employee deferral, and you match yourself 3% on the owner side. Your employee defers whatever they want up to $17,600, and you match them up to 3% of their $40,000, a max of $1,200. Total employer cost for the employee side, $1,200 versus $8,000 under the SEP. Same tax deduction outcome for you personally, dramatically less cost. That's why I'd pick the simple IRA in this exact scenario 9 times out of 10. The 10th time is when you can afford to be generous, or when you want a Roth option and a loan feature. Then a proper 401k with a safe harbor design starts to make sense, but you're paying a TPA $500 to $1,500 a year. And honestly, at one employee, that overhead eats the tax savings. Your bracket matters here. Someone in the 32% bracket saves more per dollar deferred than someone in the 12% bracket, so the math tilts toward more aggressive plans as your income climbs. If you're consistently netting over $200,000 with 2 or more employees, we're not having the simple conversation anymore. We're having the 401k or defined benefit conversation. Let's talk about what most freelancers get wrong. The biggest one, and I see this constantly, is the just write it off instinct applied to employer contributions. Yes, your match is deductible on Schedule C, which reduces your self-employment tax and your income tax, but you're still spending real dollars. A $1,200 match saves you about $400 in combined tax at typical brackets. You are not making money by making the match. You're buying a retirement benefit for your employee at a discount. Which is fine, i.e., retention, ethics, whatever your reason, but call it what it is. The write-off is not the reason. Second mistake, waiting until December to set the plan up. Simple IRAs have to be established by October 1st of the year you want them to apply to. Miss that window, and you're waiting until next year. Not April 15 like a SEP, October 1st. Circle it. If it's late September and you're reading this, stop, open the account, worry about the paperwork nuances after. Third mistake, and this one is expensive, the 2-year rollover rule. If you take money out of your simple IRA within the first 2 years of participation and roll it to any plan that isn't another simple IRA, not a traditional IRA, not a 401k, nothing, the early withdrawal penalty under Section 72T jumps from 10% to 25%. That's not a typo, 25%. So if you set up a simple, contribute for 18 months, then panic and try to move it into a solo 401k. Because your employee quit, you can trigger a penalty that erases years of tax savings. My take? Once you go simple, plan to stay simple for at least 2 full years before you consider switching vehicles. This depends on your age too. If you're already past 59.5, the penalty doesn't apply. But for most of the audience I'm talking to, it very much does. Fourth thing worth flagging, SECURE 2.0 opened up Roth contributions inside simple IRAs as of 2023. And it also made employer contributions eligible to go Roth if the employee elects it. Most of the major custodians, Fidelity, Schwab, Vanguard, finally have the operational side of that working in 2025 and 2026. If you're young, if you expect your income to climb, or if you just want tax-free growth, take the Roth election. I would. The deduction feels good today, but a decade of compounding in a Roth bucket usually wins the long game. Your future bracket matters more than your current one, and if you're honestly evaluating a career where income trends up, the Roth math almost always favors paying tax now. One more thing on eligibility that catches people. Under a simple IRA, an employee is eligible if they've earned at least $5,000 in any 2 prior years and are reasonably expected to earn $5,000 in the current year. You can set the threshold lower in the plan document, but you can't set it higher. So if you hire a subcontractor and put them on W-2 mid-year at $30,000, they're likely eligible next year, not this year, which gives you a runway to plan the match. But if you've had that same person on payroll for 2 years already, they're eligible day 1, and you don't get to opt them out. Quick word on this SEP IRA comparison since it comes up every time. The SEP is genuinely simpler than the simple. One form, contribute by your tax filing deadline including extensions, deduct up to 25% of net self-employment income up to that $72,000 ceiling. The problem is proportional contributions. Every eligible employee gets the same percentage of comp you give yourself. That's fine when it's just you. It's It's brutal the moment you have a second person on the books. So, for the pre-employee freelancer, I like the SEP or the solo 401k. For the 1 to 10 employee freelancer, the simple almost always wins on cost. Quick historical footnote. Simple IRAs were created by the Small Business Job Protection Act of 1996, specifically because Congress recognized that small employers were getting shut out of retirement plans by the compliance costs of traditional 401ks. SECURE 2.0, passed in late 2022, then modernized it, raising limits for smaller employers, adding the Roth option, and letting employers make additional non-elective contributions up to 10% of comp or $5,000, whichever is less. So this vehicle has been quietly getting better, and most freelancers just haven't noticed. Look, I help solo workers and gig workers stop overpaying the IRS. And if I had to name the single most common mistake I see in the one-employee freelance business, it's still using the wrong retirement plan for 2 or 3 years before anyone catches it. The fix is a 2-hour project. The cost of not fixing it compounds. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this cleared up the simple IRA question for you, subscribe. I put out one of these a week specifically for freelancers who don't have HR to hand them a benefits packet. And if there's a specific retirement or 1099 tax question you want me to break down next, drop it in the comments. I read them and I pull topics straight from there. Next week, I'm tackling something a lot of you have asked about. If your joint income is over the Roth IRA limit, is the backdoor Roth actually worth doing when you're self-employed, or is it more hassle than it's worth? Some of the bookkeeping tools I use to keep this stuff straight are linked below. This video may contain affiliate links. I only recommend tools I use personally. See you next week.